Hello and welcome to MIFA's webinar. Glad you could join us this afternoon. This is a webinar about saving for college, and we're going to take you through some tips that you need to know now about saving for college and talk about MIFA's college savings programs. Let me start by telling you a little bit about MIFA. MIFA has been around for 30 years. We were actually an organization started by the colleges and universities in Massachusetts who went to the state and asked for an organization that would help families afford higher education. So we were created then, and we've been doing that same work for 30 years. I like to say we break our work into three parts. We have two college savings programs for families, the U-Fund and the U-Plan. We also have private loans for families who need that type of financing when their student is in college. And then everything else we do is free. We have a public service mission, and we have free resources for all families in Massachusetts and all families that send their students to college here in Massachusetts. So I will leave you with lots of information and resources that you can have going forward. I'll also introduce myself. My name is Julie Shields-Rutina, and I'm the Director of Early College Planning here at MIFA. And I have been working with students and with families for 25 years to help them save, plan, and pay for higher education. So I think we will get started. Let me explain a little bit about the webinar format. You can feel free to type in a question as we go along. If you'd like to type it into the chat that hopefully you can see on your screen. I may or may not be able to answer the question as I'm going along, just because sometimes it's hard to talk and read the questions correctly. But for sure, at the end, there'll be plenty of time to make sure that I answer all of your questions and open it up. And if we want to have a question and answer period at the end, that's perfect. So I will start by saying I'm sure that most of you are on this call because you know that the cost of college can be significant, and it's something that we all look toward, and it sometimes causes a little bit of anxiety, or at least brings up a lot of questions for us. What I will say is I think it's a really good thing for us to know in general that the cost of college will be something we need to plan for. However, knowing some of these high costs sometimes I think can almost have a paralyzing effect on families. When we learn about what the cost of college is today, and we project that out over a number of years and think about how many children we have, how many years they'll go to college, it can be so overwhelming that I think sometimes families just, as human nature, we just put it off or don't want to think about it because it's scary. So I'm going to try to give you a more balanced way to think about that. So I'm going to talk with you about two pieces that maybe can provide some balance to some of those scary numbers that we hear about college costs. And the first is sort of shown on this chart. This chart is a chart from the College Board, and it shows college costs, both tuition and fees, room and board, and then other expenses, for a variety of different types of institutions across the country. And a quick aside is that this is a national chart, so the numbers may even look low to you for some of those private colleges, because here in Massachusetts and in New England we do have some of the very highest cost colleges. But in general it shows different types of colleges: community colleges, public four-year in-state colleges, public four-year out-of-state colleges, and private colleges. So I guess one piece of balance to keep in your mind is that there are many, many options for our students. We have so many choices, and as we watch our students grow and have dreams and interests and talents, we'll watch all of those develop. We will be able to work with our students to make sure that they keep as many options and choices open going forward. And so there are many paths to any degree, any career, and I'm going to give you some tips and tools on how to how to know that you have those resources to help your students. So that's the first piece of balance. A college cost is not one thing. And the second piece of balance I want to give you is just that there is financial aid available to help families pay for the cost of college. And you can see on this chart that $185 billion was awarded in financial aid last year to students nationwide. Now, financial aid is many things. When we say financial aid, we mean grants and scholarships, which are the best kind, money that's just given to your students outright. We also mean federal student loans, which you can see that orange part of the pie is a large portion. Most students today have some type of a student loan in their financial aid package, and also work-study programs. And you can also see on that pie chart that there are many sources of the financial aid that's awarded to students. So the federal government is a very large source of grants, loans, work-study. States also have grants and scholarships and sometimes loans that they award to students. And then the colleges and universities themselves all have some types of institutional grants and scholarships to award to students. So that 18%, that peachy color in the pie chart, shows that most colleges and universities do have grants and scholarships to award to students. So what I will say is, although there can be a variety of types of aid and it can differ from family to family, many families receive some type of aid to offset those costs. So I like you to keep that as a piece of balanced information in your mind. Now quickly I'll say that the colleges and universities that award their own grants and scholarship to students do so in two different ways. And the first is on the basis of financial need. So there is some money that is awarded based on a family's calculated financial need, and you will apply for financial aid when your student is a senior in high school, and maybe your family will be eligible for some of that type of financial aid. But many, many colleges also award some of their grants and scholarships based on merit, and that's very broad. It can be academics, it can be athletics, music. Basically what I say is that anything that makes your student a good candidate for admission at a certain school in a certain year can put them in line for some merit-based aid. I guess what you need to know now about merit-based aid is that's just another reason to do what we probably do anyway, which is really encourage our students to work as hard as they can in school, to challenge themselves, to become involved, and try to keep their grades to the best of their ability. All of those things can work toward not just academics and being admitted to a college that they want to be admitted to, but they can also work on the financial side. And quickly, I will tell you just how that financial aid formula works, and then show you how you can think about that now when you're planning to do things today about saving. The way it works is that each college puts together a cost of attendance, which is everything: tuition, fees, room and board, books and supplies, transportation, for how much it would cost a student to be there for the year. And then from completing information on the financial aid forms, there's a number calculation that comes from those, which is your expected family contribution, how much you as a family are expected to contribute to those college costs. And the difference there, cost of attendance minus what you're expected to contribute, is your financial aid eligibility, financial need. So then colleges try to make a financial aid package to cover or get close to covering that financial aid eligibility. Now the reason that number, that expected family contribution, is an important number to know is that can be a good number for you to target as far as how much you want to have saved, because there will be a portion that you'll be expected to contribute to these costs no matter what. And so it's a good idea to have an estimate of what that amount might be. If you go to the MEFA website, MEFA.org, and click on on the information on the side as far as guidance, you will be able to find an expected family contribution calculator. And you can type in information about your income and your assets and the size of your family, the number of students you have in college in a certain year, and just get an estimate of what that expected family contribution would be. And that can be helpful because is it 5, is it 20, is it 40? That will help you think about how much you need to be planning for that you will probably be asked to contribute to those college costs. And this slide shows how it works when your student is applying to different priced colleges. So this shows a family with an expected family contribution of $5,000. And if that student applies to a college that costs $45,000, then their aid eligibility for need-based aid is about $40,000. Whereas if that student applies to a college that costs $5,000, then if the cost is $5,000, your expected family contribution is $5,000. In that case, you wouldn't be eligible for any need-based aid. So for this chart, really, I say to families is you shouldn't be discouraged by the cost in general. The cost will be dependent on a financial aid package received too, to see what your actual net costs will be. And I should add that all colleges also have something called a net price calculator on their website. I've seen some pretty good ones. It's nothing that you'd want to be making decisions about when your children are younger, but just to give a sense of a family with your financial situation, what type of aid might you receive at a certain college. It will just give you a sense of how much that college may actually cost you net. So because I talk about financial aid a lot, and I always want families to apply for financial aid when their students are getting ready to go to college, and then I turn around and I encourage families to save, this is a statement that I get anytime I'm talking with families. People will say to me, well, Julie, why should I save? If I save for college, won't that just mean I get no financial aid? And actually, the answer is false. Although it's a huge misconception out there, and I think it is a thought that sometimes is something else that has parents put off saving because they're just not sure if it's a good idea or a bad idea. So I'm here to tell you saving is a good idea, and I'll show you why. So this is how different parts of your parts of your finances are treated in that financial aid process. And so you can see that when that expected family contribution calculator is working, anywhere here from 0 to 47% of a family's income is expected to be used for college costs before financial aid kicks in. So you can see that sometimes those expected family contribution numbers, or I shouldn't even say sometimes, all the time, they feel very high. There's a lot expected of us to pay toward college from our own income. However, you can see the next green bar, which is parental assets, and that includes cash, savings, checking, any of these college savings plans, if you have other investments in real estate, all of that is considered in the formula, but it's considered at a very small rate, a maximum of 5.6%. So my easy example that I give with that, well, I give two. If you have $10,000 in a college savings plan, that increases your expected family contribution by $560. If you have $100,000 in a college savings plan, that increases your expected family contribution by $5,600. So it is just so much better for you as a family to have those savings, and even though they're counted minimally in the financial aid formula, they don't decrease the amount of aid you could receive by too much, and it gives you so much flexibility to have that college savings. So you can also see that student income and student assets are treated a little more harshly in the financial aid formula, with the thought being that the students are the primary beneficiary of the education, so most of their resources should go toward paying for college. And this is just another example of that, to say here are three families with the same income and very different assets, 0, 75,000, and 150,000. And you can see that the expected family contribution goes up just ever so slightly with big increases in savings and assets. So the bottom line is you would much rather be family B, or you would much rather be family C, with a higher expectation toward what you can contribute toward college, but having those assets to be able to make decisions and pay. I will quickly tell you that your retirement assets are not included in the financial aid formula, so that's another important piece of information to have. And there are a couple of different financial aid forms. One is the federal form, the free federal form. It's called the FAFSA, and all colleges require that. There are some colleges that have a lot of their own resources, their own money to award in financial aid, that also require families to complete a different financial aid form called the profile form of the College Board. And there's a major difference asset-wise in what's collected on each of those forms. So in the federal formula, there are no questions about your primary residence, whereas the other profile form does ask questions about your primary residence, and the equity in your home is considered part of your assets. Still calculated at that 5.6%, but part of that asset calculation. And then this is just to show you three families with different income, 60,000, 100,000, 150,000 in the same assets, and you can see that that expected family contribution goes up significantly with changes and increases in income. So again, back to the point that a lot is expected of us to pay for college costs out of our income. Probably it's going to feel like too much for us, and that's why we really need our savings to be able to meet that expected family contribution. So this is another thing I hear from families a lot, that these costs seem overwhelming. All of it seems so overwhelming, and people will say to me, well, what is my $50 a month or $100 a month going to do really toward paying what are probably going to be these really high college costs? So people will say, it's not worth saving if I can't save the whole amount. I'll just skip it. we know, you knew that is false, that anything you can save is going to be a help to you. And I'll tell you a little story, that we do a big program here at MIFA in April each year. And during that time, we call it After the Acceptance, and we meet thousands of families, parents and students who are getting ready to send their students to college. And the parents and the students come to these programs, and they come to us with their admissions letters, with their financial aid award letters, and we help them compare those award letters. We help them think about how to make the college decision, how they're going to pay. And at that point, families really are comparing apples to apples. They know all of the different costs. They know all of the different financial aid packages, and they can see a bottom line of, okay, if my child goes to this college, this is what we're going to pay. If my child goes to this other college, this is what we're going to pay. And once they have that bottom line, and as a family you know what you need to pay, you really only have a few choices about how to meet that cost and how to pay that bill. And the choices are, you can use savings. You can use any savings resources that you have. You could also use some of your present income. So a lot of people do pay some of those costs as you go along, as you would pay any other monthly bill. Colleges have monthly payment plans. You can break out the payment over 9 months, 10 months, 12 months. So a lot of people pay a bit out of present income. And then many families say, well, I might need to borrow a loan, and that's maybe even a parent loan or a student loan over and above the federal student loans, which have limits. So at that point, most families do a combination of these things. And what I can tell you is that when I meet these families, and again, I personally meet hundreds and hundreds of them, no matter what their income is, they all say the same things to me. They all say, I wish I thought about this sooner. I wish I started saving sooner. I wish I saved more. Because anything that they have in that savings part of their options really helps reduce the pressure on their present income and really may either reduce their borrowing or allow them to borrow a lot less. So that's my reason for enjoying sharing some of that with parents who have younger kids. That anything you can do now will be a help. So as I guess we've gotten the point across that savings will be a help to you. It will be a good thing, and there are lots of options with how you save, and really any way you save is going to be a positive. There are some ways to save that are specific to saving for college, and we're going to talk about a few of those. 529 plans, prepaid tuition plans, Coverdell education IRAs, all are products specifically for saving for college and have some tax benefits associated. So we will talk especially about the MEFA-U fund and the MEFA-U plan in a moment. There are other ways that families can save for college, and every family will kind of look at all of these options and see what's best. You could just save in a regular bank account, CDs, money markets. The difference there is that there are no real tax benefits. If you earn interest on those accounts, you pay taxes, but there's a lot of flexibility in if you just have your money in a regular bank account with no, and it's not designated for anything specific. I always sort of joke with people and say that flexibility is a pro and a con, because it is wonderful to have access to your funds to use for anything, but we also know we have lots of reasons to emergencies, things that come up, to use our money, so that flexibility can be a drawback as well. There are other types of accounts, Uniform Gift to Minors Act accounts, so money that it can be in a student's name. I would say that that can be fine. There's some flexibility to those accounts for a student. Two things to note about those accounts is they are considered student assets in the financial aid formula and counted at 20%. And the other important thing to know is that these accounts are the student's money. So if the student knew they had that money and wanted to take that money at age 18, the money would be theirs if they decided they wanted to backpack or whatever they wanted to do. So, so that is the student's asset. And there are other things like United States savings bonds, retirement accounts. So I would encourage you to look into other options for saving as well. But the financial advisors that I work with in this setting, have usually talked about not touching your retirement accounts, of leaving those and maybe using a vehicle that is for college. And this slide quickly shows the benefits of tax-deferred savings. So the accounts that I'm going to talk about next have tax-deferred benefits. And this is just, I'm going to take this as the simplest example to just say that if you are able to save in an account where you don't pay taxes on the interest that you earn, and it can just get added back into the account, you over time are able to build and save more than if you put your money in a taxed account. So that's really the point of this slide. So now I am going to talk about two just really good plans. As we said, saving in general is the key. But I'm going to talk about two good plans that we have here in Massachusetts. And the first is the U Fund, the MEFA-U Fund. And this is the Massachusetts 529 plan. So all states have 529 plans. This program was set up, 529 plans were set up specifically for parents and others to save for college for a child, a student. And the MIFA U Fund is Massachusetts plan. And the way this works is you open an account, and you can actually open an account for as little as either $50 one time, or open it and have $15 a month automatically invested. And doing either of those will open the account for you. Then once the account is opened, you can add money once in a while or regularly, and as you save, you don't pay any taxes on the interest that you earn. And so you go along saving, and at the time that you want to use the funds, as long as you use them for college expenses, and the sort of term is qualified higher education expenses, such as tuition, fees, room, board, books, supplies, required equipment, any of those educational related expenses, then you can take the money out and you never pay taxes on the interest that was earned on that account. So you really are saving tax-free as long as you use the money for higher education expenses. I like the flexibility of the number of expenses that you're able to save for and still get that tax benefit. I also like the flexibility that you can use these accounts, so you know the U Fund or any other 529 plan, you can use the money at any accredited college or university in the whole country, and there are even some international institutions on the list. So it's very flexible with how you use it, what you use it for. Again, small investment to open one of these accounts. When you can open the account either online, fidelity.com/ufund, or you can call that 1-800 number. And really, the process of opening the account is fairly simple. There's just you will have to make one decision that will be important when you open the account, and that is how you would like your money to be invested. And there are lots of choices, and Fidelity can help you think through as a family what type of an account you would like to invest your money in. And they really range from very, very safe bank deposit portfolio type of accounts. There's even one that's FDIC insured, all the way through fairly aggressive mutual fund portfolios. So again, that will be an individual decision, and there are great folks at the other end of the phone at Fidelity that can help you make that decision. I'll quickly mention that a common type of fund that a lot of people choose is one of the funds called age-based, which just means that portfolio of mutual funds starts out much more aggressive when your child is younger, and it automatically gets more conservative without you making any changes. It gets more conservative as your child gets older and closer to college age and closer to you wanting to use the funds, because you don't want to take the chance at that point of losing a lot of money. So some decisions to be made there, but I think that this is a great flexible account for all kinds of families. I'm going to go to the next slide, and I'm going to talk about a different type of account, but another great option for people here in Massachusetts and elsewhere, and this is the MIFA U plan. And this is a prepaid tuition plan and works a little bit differently. So the way this one works is that as a family, you can buy tuition certificates today, and I put that in quotes, and I'll explain why today, this year I should say, and you can prepay tuition, and you can lock in a percentage of tuition at 80 participating public and private colleges here in Massachusetts. So the example I like to give, I'll go to this next page, is let's say that you have $1,000 to invest. Then you wouldn't be locking in at a specific college. You would put that $1,000 into the U plan, and that would be 20% of today's tuition at college A it might only be 10% of tuition at College B and maybe 6.67% at College C. And each year, you would just receive a report that would say that your investment is worth this percent at all of these different 80 participating colleges and universities. And then you can continue to add to that each year. Now, a couple of things about the U Plan. It is only for tuition and fees, and it is only for undergraduate college. And the reason I put today in quotes is there's only one time of year, and here at MIFA it's May and June each year, one time of year that you can add money to this program. So if you're interested in this program, I tell people two things. One, go and check out the video, the cartoon video on our website. I think it's really good. It does a good job of explaining this as well. And then sign up just to receive the materials so we can send you the materials next spring before next spring's enrollment period. Now, and here is the list of the 80 participating colleges and universities. So you can see public, private, a number of different types of institutions. So then the big question that I get is, well, what if my son or daughter doesn't go to one of these colleges, then what happens? So what happens is then you would just cash out your account at that point. If your student went to North Carolina or California or something, you would just call MIFA and you would cash out your account and you would receive the amount that you put in plus CPI interest that has accrued over the years. So you don't lose anything, but you would get a standard amount back, what you put in plus the CPI. So I don't necessarily think it's an either or when I talk to families about the two different MIFA savings programs. I think people can have both. I think one might be better for one family than another. I think there are a lot of different options, all good part of your plan. So let's talk about the what ifs. We always get a lot of questions about this. And I'll try to go back and forth between U-Fund, U-Plan. Hope this doesn't get too confusing. So, okay, so what if you withdraw the funds for another purpose? Well, let's go back to the 529 plan, the U-Fund. If you put money into the U-Fund but then have an emergency and need to take your money out for some other reason besides college, that's fine. It's your money and you can take that out. But what happens is then you do pay taxes on any earnings, any interest that you earned, and you also pay a 10% penalty on any interest that you earned. So keep that in mind if you use the money in the U-Fund for another purpose. I'll stick with the U-Fund. I'll go all the way down the 529. If your child doesn't go to college, I guess what you could do before you took the money out and paid taxes on it and paid that 10% penalty on the interest is you could first change the beneficiary, because you can change the beneficiary on these accounts once a year, and it can transfer right over to another student who hopefully will go to college. It's actually very flexible. You can change it to anyone who's a relative of the initial beneficiary. So it could be cousins, it could be yourself. So there is some flexibility there of how you can use those funds without taking them out and paying the taxes. That goes same if your child graduates without using all of the funds, you can change the beneficiary. Or the U-Fund 529 plan can be used for graduate school as well. Now, if your child receives a scholarship, which we hope, then what happens is you can take money out in the amount of the scholarship, and you still have to pay regular income taxes on the earnings, but you don't have to pay that 10% penalty. And there are two other ways that you avoid the penalty as well. They are scholarship, death, and disability. So if something horrible happens, you also can take the money out. You just pay taxes on the interest, but you don't have to pay that 10% penalty on the interest. And then with the U-Plan, if you take your money out for any reason and use it in any other way other than, at those 80 participating colleges and universities, then it is just considered a cash out, and you receive your money back with CPI interest. So that's how that works. So we're getting near the end. I'm just going to give you a few strategies that we have found useful for families, and from what we have seen from our experience working with parents, with all students of all ages. The first one, and I've said it in numerous ways already, just start saving as soon as possible. I mean, open an account that you designate as college savings, and use time to your advantage. You can put small amounts in there. As you can see, this time value of money chart below shows, how much $50 a month or $100 a month or $300 a month can really add up to by the time your child is going to go to college. Do not put the pressure on yourself to feel like you have to save every last penny, because there are, as we described in the beginning, many unknowns as to the path that your students will take, and many options, and you'll want to just keep all those choices and options open all the way along. But it will always be helpful to you to start saving something as early as possible. And it is true, although it's true that you don't have to save on a regular basis, there's all kinds of research that just shows that when you set up an account and use automatic transfers and have money going in monthly, even if it's a small amount, that you end up saving more if you don't have to make that decision each month about what to do with some extra cash, and it just happens automatically out of a paycheck, out of a bank account. It's more likely that you will continue to save, and more likely that your savings will grow faster. A couple of other strategies are, once you have one of these college savings accounts open, it's something you can say to relatives, friends who want to give a gift to your child over time, just to say, what would be great is $25 into the college savings account. And, I think that feels good for family members, for friends, to want to add and feel like they're doing something really great and really useful. And maybe it will cut down on the clutter in our homes as well. And something else that I didn't tell you, but I have a junior in high school, and I also have a 7th grader. And so as your children get older and start working and earning some money themselves, it's a great idea to involve them in the process and have them add some of the earnings that they're able to earn from their jobs into the college savings account. So before we end and take some questions, I hope that this has been useful, and I hope you will stay connected to MIFA, because we have a lot of resources that you can use over time. So a few things to know. If you go to our website and sign up for our email service, and actually I think when this webinar closes, you might even have an opportunity to do it here. We have emails that are targeted to the age of the student, and we will continue to send useful, pertinent information to you all the way along. So that's terrific. And just to know that we do over 500 free seminars out in the community, at high schools, at libraries. So on our website you can also see where we are for free seminars, which are extremely popular as kids get into high school. Stay in touch with our website. In addition to that, you can always call us, you can email us. We are on Twitter and Facebook. So find whatever works for you and stay connected to MIFA so that you can just take advantage of all of these resources going forward. And here are just some helpful websites for you. I'm going to actually take 10 more seconds to talk about Your Plan for the Future. That is a college planning website that your students can use in middle school and high school. And it's robust. It has lots of information about there are skills tests that students can take that will then give them career ideas, and then you can search colleges that have programs that might lead to certain careers. It's fun. It's targeted at students, whether they be at middle school or high school. So that is a free website and a terrific one that can be helpful. And then these other websites, Fidelity, savingforcollege.com, College Savings, are all great, have great information about college savings plans. And this is just an example of what the MIFA website looks like. If you haven't seen it, all of the different tools and ways to stay connected to us. So this is me, Julie, and my colleague Angelina. And there's all of our information, plus the general info at MIFA, email and telephone number. So I'm going to stop talking and open it up in case people want to ask questions into the chat. And I will try to make sure I answer all of those. Okay, and I have some. So there's a question about this webinar being recorded. Yes, it is being recorded, and we are going to have this on our website. So you will be able to access this webinar after the fact, and we will let you know where that is going to be, and you'll be able to find that. So the next question, someone asked, can you define a non-retirement asset, the value of the home, less mortgage? So yes. So we talked about when you complete the financial aid forms, you'll put down the value of assets, such as cash, savings, checking. And then there are a couple of assets that might have debt associated with them, one being a home or an investment property. And the amount that's counted in the financial aid formula is just the equity. So if you're asked about your primary residence, such as on the profile form, not on the free federal FAFSA form, they would ask you, what is your home worth and what is owed on it? They also on the profile form ask you when you bought it and how much you paid for it. So to come to a calculated asset for that. So that's how that works. Other real estate property would all be value minus debt, and the equity figure would be what would be used to determine the amount of that asset. Oh, so there's a good question about the chart that I showed about saving over time. I'm going to try to go back to that if I can. Maybe I can't. Well, I showed you the chart about saving over time, that if you save $50, $100, $300 over time, that can add up to significant savings. And someone asked me what that was based on, and I believe, but you know, I will actually double check on this because I can't get back to it yet. I believe that was based on a 7% return, which is sort of a long-term, I won't even call it an average, but a long-term return that has been seen in a number of the savings plans over time. So I will check on that, and if you would like to email me about that later, I can confirm exactly what those numbers were based on. But the addition to that question is, would that chart be based on FDIC insured options? And my quick thought would be no, because I think those very safe options like the FDIC insured bank deposit portfolio usually have a much smaller return than some of the other mixed options. So I think this next question is asking about these two options, the U Fund and the U Plan. Are they considered student assets? And the answer is no. That's the good news about these accounts. They're considered parent assets. So 529 plans across the board nationwide, including the MIFA U Fund, are considered a parent asset in the financial aid calculation. And The U plan and all prepaid tuition plans are also considered a parent asset, which means they're calculated at 5.6% because you are the owner, or the adult is the owner, and the student is the beneficiary. So student assets are assets that are actually in the student's name. So now there's a question about a relative open to 529 for my child in another state. What are some of the differences in 529s among states? So that's a terrific question. What I described as far as 529 plans to date, to the moment in this call, it's true for all 529 plans. They all have those tax benefits. You can usually, I don't know if it's exactly $50.15, but you can usually open these accounts for relatively low amounts of money. Everything I described is the same from state to state. The things that are different are that if you live in a particular state, sometimes that state will have additional tax benefits. You know, if your relatives live in Wisconsin and Wisconsin has a state tax benefit, that might be a good reason to open a 529 plan in that state. In Massachusetts, they're tax-free, federal and state tax-free, but we don't have any additional tax deduction or credit. So that means, you know, but unless you live in a state, if you do live in a state that has one of those, that's a good reason to go to your home state first. Other differences are just who is the program manager. So Fidelity Investments manages the U Fund. If you like Fidelity Investments, if you like the service you can get with Fidelity, the customer service, the online options, all of that, then that can be a real positive. If you like a different type of program manager, then different 529 plans have different program managers. So you want to think about service, all of those things. Fees can be different from state to state. In general, Fidelity is a low-cost brokerage firm, but you want to check out those fees from state to state. Those websites that I gave you, collegesavings.org and savingforcollege.com, compare 529 plans across the country. So all very good. So another question I'm receiving is, let's see. Will the slides be emailed or accessible on the website? We'll email them to you. So we have your email address for signing up for this webinar, and we will send you an email, and you can have a copy of the slides. So someone is asking, can I make automatic deposits into a U fund and then once a year move the deposit into the U plan? Great question. Unfortunately, the answer is no, because they're two different types of plans. So you can transfer money from one 529 to another 529. The MIFA U plan is not a 529 plan. It's a prepaid tuition plan. And so unfortunately, you can't move the money back and forth. So that's too bad, but no. So someone is asking, have a 529 prepaid tuition plan and using Roth IRA as extra way of saving toward college now. And you like the Roth IRA as an option. You know, I guess what I would say, that goes back to the beginning of overarching this entire presentation. Having a plan, having it in place, saving regularly is the most important thing. And so I think if that plan is working for you, I think that's absolutely fine to be using all of those different options. And my only caution about the retirement piece is that what financial aid offices have seen these last few years is a lot of people liquidating their retirement funds to pay the bills because they had no other options. So, families who have to do that because they didn't plan, I think that feels like an issue and maybe will jeopardize retirement. But if it's part of your long-term plan and you're using that as a conscious plan, I think you're fine with that. And we will email the presentation. So I'm getting some questions from grandparents and how things are different for grandparents. So let me take a moment and describe that. I think it's wonderful, grandparents saving for your grandchildren. That gets a little bit, there's a little bit of gray area in that for the financial aid process, in that if a grandparent is saving for a grandchild, it doesn't get included when the family, the parent and the student apply for financial aid the first year, because it's not on the financial aid forms. It's just asking about parents and students. So the determination of need is not made based on any of those grandparent assets. However, any grandparents or relatives or friends that end up paying some of the bill with college savings funds. So after the funds are withdrawn and do pay some of these educational expenses, there are questions on the financial aid forms going forward in the student's life at a college that say money's paid on your behalf, things like that. So they can get reported, they will get reported, the second, third, fourth year. So that's a little bit gray that could change the financial aid at that point. I would say if you have further, more detailed questions on that, you can feel free to email me or give me a call, but that's how that works. It's not included to start, but as bills are being paid by others, it gets collected on those financial aid forms. So I hope I have answered all of the questions here, so that everyone can hear those answers. But if there are other questions that I somehow inadvertently skipped, please feel free to email me, call me, and we're very happy to continue to help you with all of your questions going forward. So I thank you for your time. Please do stay in touch and know that we're here to help you. Thank you.